Let me ask you a simple question. If you had a job that paid you $50,000 a year, and you had $2 million in the bank, would you go out and borrow $85,000? Probably not. You don't need it. Now, apply that same logic to Google. Google makes tens of billions of dollars in profit every year. They have hundreds of billions in cash and assets. They are one of the wealthiest companies in the history of the world. Last week, they raised $85 billion by selling stock. Why would the world's most profitable company need more money? The answer is not what the headlines are telling you. And once you understand the real reason, you'll see the AI boom in a completely different way. Let's start with the numbers, because the scale of what's happening is almost impossible to believe. OpenAI, the company behind ChatGPT, the most talked about AI product in history, spent $34 billion last year to make $13 billion. They lost $21 billion in 1 year, and they plan to burn over $850 billion by 2030, that's not a typo, $850 billion at the same time. Google is raising $8 to $5 billion. SpaceX wants $7 to $5 billion from public investors. Anthropic, the company that makes Claude, has already raised $65 billion privately and is preparing to go public.
Add it all together, and you're looking at somewhere between 300 and 400
billion of AI-related stock that needs to be sold to the public in the next 12 to 24 months. That is an enormous amount of money that has to come from somewhere. The question is, where? Here's where it gets personal. After the 2008 financial crisis, interest rates dropped to nearly zero. And that created a problem for pension funds and retirement accounts, because their whole job is to grow your money safely over the time. When safe investments stopped paying decent returns, pension managers had to find something else. They turned to what's called private credit, essentially private loans made to companies outside of loans. The normal banking system, private credit, is now a massive, largely unregulated industry, and it is deeply invested in AI data centers. Think about that chain for a moment. Your pension contributes to a private credit fund. That fund lends money to build AI data. Those data centers rent their computing power to companies like OpenAI and Anthropic, companies that are currently losing billions of dollars every year. If those AI companies can't pay their bills, and right now they can't, that ripples back through the entire chain, back to the data centers, back to the private credit funds, back to your pension. This is not a hypothetical. This is the structure that currently exists. Now, why did Google suddenly decide to raise $85 billion by selling stock? Google is one of the most profitable companies in the history of the world. They make tens of billions of dollars in profit every year. They don't need money. But here's what Google understands, that the window might be closing. Right now, investors are excited about it, but most retail investors don't. AI, they're willing to pay high prices for anything AI related. Google knows this, and Google wants to raise as much capital as possible. While that excitement still exists, there's another dimension to this too. When Google sells $85 billion of stock, That money has to come from somewhere. It gets absorbed out of the market, which means there's $85 billion less available to buy SpaceX, Anthropic, and OpenAI when they go public. Google moved first, deliberately, and that tells you something about what they think is coming. I mean, look at this Google checkmate. I want to be careful here, because I'm not saying a collapse is certain. I don't. Understand where the markets are, but nobody can predict what is going to happen. Nobody does. What the downside looks like, because very few people are talking about it honestly. OpenAI alone accounts for $300 billion of Oracle's projected future revenue, a quarter of $1 trillion of Microsoft's projected revenue, $138 billion of Amazon's. If OpenAI runs out of money, or if investors stop funding it, those revenue projections disappear. Which means Oracle, Microsoft, and Amazon all take massive hits at the same time, which means NVIDIA, whose chips power all of this, loses its biggest justification for its current valuation, which means every AI-related stock in your index fund drops together at the same time. And if the private credit funds that are financing AI data centers start to crack, the pension funds and retirement accounts that invested in those private credit funds they're exposed to it. So what do you actually do with this information? First, analyze. Losses too. This is what interconnected financial risk looks like. And most people have no... Don't panic. The AI boom is not going to collapse overnight. These things take time. And there are genuine opportunities in the transition. Second, be honest with yourself about where your money is. If you're holding broad market index funds, you're already heavily exposed to AI stocks, whether you know it or not. That's not necessarily wrong, but you should know it's there. Third, think seriously about genuine diversification, not just across different stocks, but across different asset classes that don't move together when tech sentiment turns negative. This is exactly what you need. One of the core reasons why a growing number of investors are looking at crypto, not as a get-rich-quick trade, but as a genuine diversifier. Crypto doesn't move in lockstep.
With AI stocks, when tech sentiment crashes, crypto follows its own dynamics. The key is
having a framework, a systematic way to think about which crypto assets to hold, how, and when to adjust. Without a framework, it's just speculation. I've linked 2 resources in the description below that I think are worth your time. The first is Intelligent.
Cryptocurrency VIP, a structured system for navigating crypto markets. The second is Keystone Investors Club.
And while the market might look like this digital storm, with the right strategy, your portfolio can sail smoothly. Portfolio that survives market cycles. Both links are in the description. No pressure. Take a first look and see if either fits where you are right now in the next video. In this series, I'm going to look at OpenAI's actual financial statements and show you exactly why losing $21 billion a year is such a dangerous problem for the An. And it's going to affect the entire economy, not because OpenAI is evil, but because of how deeply connected it is. To everything else, subscribe and hit the bell so you don't miss it. I'll see you in the next one.